Good morning, everybody. I'm Brian Athey, the president of Congressional Capital, and I'm here with Chaz Anderson of Congressional Capital, the kid from Alaska, as we affectionately call him. And we're here for Hard Money Monday, where every Monday we're going to be talking about a topic that hopefully interests our viewers about the hard money lending industry. So Chaz is going to kick it off with some hard money myths that he's run across in his shorter time. I've been doing this for so long that sometimes I forget, what the myths are out there. And Chaz, joined us. How long has it been, Chaz?
About a year and a half now.
About a year and a half ago out of UVA, and so he's newer to it, although not new anymore. He's kind of come across a lot of different types of deals and a lot of different myths that are out there. So Chaz, kind of what's the most pervasive myth that you see out there?
Yeah, so I get a lot of different myths brought up to me just, interfacing with borrowers on a day-to-day basis. But one of the most frequent ones I get, quite often is that hard money loans are risky and really should only be used by, desperate real estate investors. So what would you kind of say to that?
Yeah, I mean, first of all, I hear a lot from investors in hard money loans, from certain borrowers, et cetera, that, hard money's for people who are desperate and really can't get loans from somewhere else. And that's just really not true. I mean, we have numerous borrowers who can and do borrow from conventional banks, but they use hard money when it fits the deal, right? So, they'll use hard money when there's speed in play. So if they want to close on something quickly, I mean, we've closed deals in as little as 3 days. As soon as title can be done, we can close. We regularly close deals in 7 to 10 days. Also with different loan structures, so if you go to a conventional bank, as many as you know, and I'm on the board of a local bank, so I know the banking industry pretty well. Their loan structures are really finite, so you're often looking at putting down 25% or 30% or 20%. Whereas hard money lenders, many of them are very, can be very flexible. I mean, here we have loans where people put down nothing. We have loans where people put down 10%. We have loans where people put down 20% if they're kind of overpaying or for some other reason. But hard money is sort of the land of creative structure, or at least it should be. That's kind of where hard money got its origins. I mean, things have changed over the years. Now there's loan buyers who sell highly structured loans to end buyers. Sort of Wall Street backed venture funds. Those loans tend to be far more structured than kind of the local hard money lenders like our company and a few others. And the part about hard money loans being risky, look, deals are risky. If you buy something, you pay too much, the margin's not there, et cetera. The loan product itself, should be very transparent. You have a term sheet that lays out all the terms. Get the loan documents, you can review the loan docs. I wouldn't say personally there's anything particularly risky about the loan in and of itself. People can reduce risk by buying something at a good price with a good margin, and having a good team. So what other myths do you find out there on the street?
Well, I think also building off that, it's important to kind of define risk because a lot of, different investors view that in different ways. And I think one of the other things that we really offer that kind of helps mitigate risk is just, industry knowledge. We've developed very extensively in the Washington, D.C. market for, over 10 years. And because of that, we're really looking out for things that some newer investors might not see, and whether that's heritage trees on properties, making sure that we have chimney extensions in place if you're looking to extend your building up, market knowledge, all of that is things that we really know that helps kind of mitigate a lot of the risk for especially newer investors.
Yeah, that's a great point. In fact, I was meeting with someone, a really good friend of mine, who doesn't actually borrow from us right now. But I was talking to her about, some of the things that I've seen over the years go wrong in condominium projects. For example, where borrowers or others run into issues where, they're not doing proper sound mitigation, for example. I mean, frankly, our borrowers know better than that. but I've seen examples in the development community where people just aren't doing the things that we recommend you do to ensure that you meet your minimum sound transmission quotient, which frankly bank lenders don't know things like that. I mean, they don't know about heritage trees, they don't know about sound transmission quotients, they don't know about the fact that in the RF1 zone you can't go back 10 feet beyond your neighbor's property when you're doing an addition. I mean, those are all things that are like breathing to us that most folks don't really know.
Exactly. So I think another, moving on from there, another important myth that I get quite a bit is that hard money is too expensive. I guess, how would you address that?
Yeah, well, hard money is expensive. There's no doubt, but it's not too expensive. Quite obviously, because I've seen and helped many people go from I'm thinking of one of my best borrowers of all time, go from doing his first house flip in 2011 to really building and scaling a business through hard money. So now he went from that house flip to doing I don't even know, but 80 or 100 units a year at least. Has built out a really robust and successful development company. And without hard money, he couldn't have done that. I mean, he didn't have the capital at the time to put down 20% or 25 or 30%. He didn't have the financial strength to get a bank loan in terms of, a personal guarantee. Really at the time, and even today, we were underwriting him as a human being. I believed in him. I thought, because I had seen him do construction on projects of mine and otherwise, that he would work really hard and be successful. And, I'm blessed to have been a part of his success, watch him, be successful beyond probably his own, dreams at that time, and to call him a really close friend. So, look, hard money is expensive, but it has its place, which is in situations, again, where speed is at a premium, or maybe you can't put down as much money, or don't want to put down as much money, or you need creative structure. I mean, the other thing that's a benefit to hard money is, just the other day I was talking to a borrower of mine who's finished with a 2-unit condo project, and he wants to add $150,000 in debt to the property. Well, if you go to a bank, they're going to want to reappraise the property. They're going to say the appraisal's stale, and that even though the units are finished and on the market and the leverage level appears to be appropriate, that they need a new appraisal, and that's going to cost $3,000 or $3,500. Whereas for me, I mean, we solved it over text. I said, sure, we can do it. When do you want it done? We're doing it this Friday. So the creative structures and the ability to be flexible really can mitigate the cost of hard money.
Yeah, and I think two other things to add to that. I think another really big benefit to us is, we fund construction draws very quickly, usually within 2 to 3 days. And what we've noticed with, some larger conventional lenders is it's going to take a lot of time to actually get those draws funded. So that's really going to increase your overall carrying cost, which, in addition is going to have your overall debt just be higher and higher. So that's one thing to think about. And then also referring back to just our knowledge of development, we're really looking out for any borrower, in their projects, and just making sure that all the pieces are in place. So in that way, they're not spending money on things that they didn't even anticipate for. So, on a pro forma, while conventional debt might be, a little bit lower, making sure that they're not incurring these costs that they didn't even think about, because we're, really underwriting the deal very stringently, is really important, I think, as well. So
yeah, I mean, it comes sort of back to like the definition of expensive, right? Is it expensive to pay a little bit more for debt, but get the knowledge that, hey, look, maybe you shouldn't use a contractor, contractor A. We know contractor B, who's actually done a bunch of small condo projects, and instead of spending more time, energy, and money trying to get contractor A to finish on time, or having to, I've seen this before where we recommended a construction group to a borrower and he said, oh, they're a little too expensive, went with someone else, and then he had to fire that contractor and then hire the person we recommended and then spend more money in the end, right? So, especially if you're earlier on in your career, our knowledge, our connections to, the right condo doc lawyers, the right construction teams, the right surveyors, can be really valuable and help mitigate the, air quote, expense of hard money.
Right. And I think, with us too. A little bit of what you're paying for is peace of mind in your project. So having and making sure everything's all buttoned up is very important and worth paying that extra premium.
No doubt
sure.
about it.
So with that too, another myth I get often is hard money is always more expensive to bank debt. I know we kind of covered that in the last question, but can you expand on that a little bit?
Yeah, I mean, I think what I hear a lot about is if you can use bank debt, why would you ever use hard money? And I think the answer is a couple things. First, hard money is a lot more flexible, as we went over. Hard money requires less money down, so you can use your capital on other deals. And the other thing, really, that I have borrowers who bank extensively with local banks, and then always have some deals with our company because they know that if they have, say 3 or 4 deals going at once, that if they run a little short on capital, they can, email or text us and say, hey, can you take one of my projects and add a little debt to it? I need some capital, in 3 days, 4 days. And we can do that, whereas, banks just can't be flexible enough. I mean, they have regulators breathing down their necks, constantly auditing them, and flexibility is not something that banks really offer.
Right.
So, what else do you see out there, Chad?
So I think another one you kind of touched on it was if you have the option to use bank debt or larger commercial financing, you should always use that over hard money.
Yeah, like I was saying a minute ago, it really just depends on the deal. I mean, if you need to close in 10 days, or if you need to close maybe in 21 days, you've got to really consider: is this a seller who'll give me an extension if the appraisal doesn't come through? Is this a deal where I know for sure that the bank's really going to come through for me? If you're newer to bank borrowing, am I really going to get approved? I mean, maybe the junior lender at the bank says, yeah, I can get you approved, and then it goes to loan committee and there's a problem. So, look, all deals are different, and people should look at each deal independently and decide, what the best course of action is. But, I can say one thing for sure, that as our borrowers know, that if we say we're going to do something and we commit to doing it, we always do it. I've never pulled a term sheet on someone before. I know at the beginning of the pandemic, there were hard money lenders that were pulling term sheets. They were getting close to closing, and because their capital dried up, they didn't proceed with closing. That's something we haven't done and never would do. In fact, in the earliest days of the pandemic, I vividly recall a pretty good sized loan that I was doing, and the borrower called and said, "Are you still going to do this? I know it's a scary time." And I said, "Well, look, I believe in you, and we'll get through it." And we funded it, and he went on to develop 4 condos and had a very successful deal. So, truth is that if you're going to pay a little bit more than bank money, you need a team of people you can rely upon to execute, and folks can call around and ask. We always, again, do what we say we're going to do here. And so, anyways, but one of the things that I hear a lot too is that sort of all hard money loan structures are the same. And, it's just really not the case. I mean, as I mentioned earlier when we were talking, when I first started this hard money lending company in 2011, the hard money space was one of creative structure exclusively, where it was mostly smaller kind of mom and pop hard money lenders who kind of made up the terms as they went. And the idea was to be fast and be a resource when banks weren't available. But to have very open and creative structures. That's how I cut my teeth, and that's how we do things here still to this day. But, then came, 4 or 5 years later, there were suddenly loan buyers who wanted to buy hard money loans in big pools. So they wanted to buy, in all the major gateway cities, DC, Los Angeles, Chicago, etc. And in order to do that, there needs to be a finite structure. And that structure, is often put down, 15% or put down 10% in every deal, fit this box, and then we can sell that box to the loan buyer. And while sometimes those loans are a little less expensive than what we may offer, they're much more highly structured. So those structures are quite different than what we offer here. And we pride ourselves really in matching the loan to the borrower's need. but ultimately, what we're doing here, as Chaz knows, is we're betting on human beings, right? So hard money lending at our level is more psychology than it is math. I mean, it's more, is this person going to work hard? Does this person have the right priorities? Meaning, they're honest and they're out working to, try to make a better life for themselves and for their family. And do they want, our help to help them along the way? Versus people that are sort of in it for the shine. They're trying to buy fancy cars and ride around on big boats and impress people, but they're not in it for the right reasons. So we try to really lean into people, figure out who they are and why they're doing this, and then once we trust them, we kind of go all in. We put our chips into on the table and do everything we can to support them. So, Chaz, are there any other myths that you've heard of out there, or you think that we got it for today?
Well, I think kind of on a similar note, one question I get all the time is kind of, do we have a formal pre-approval process? And we really don't. There's no application you have to fill out before you actually send us a loan deal. But going back to what you're just talking about, most of our underwriting and due diligence is concerned with the borrower. Like, do they have the right intentions? Are they doing the project for the right reasons? Do they actually, care at the end of the day?
Right.
And if all of that, satisfies the criteria, we're going to be very interested in actually funding a loan. And subsequently, we're going to want to, develop a loan structure, whether it's the first deal, the second deal, the third deal, to really suit their needs for that project specifically. So that way they can get the most out of that project. And obviously, as we do more and more deals with them, the terms are going to get better and better, and we can do more things, once we have more confidence in them. But really, our underwriting up front is just, making sure we know the borrower and what they're looking to do and get the most out of their projects there.
Yeah, that's right. I mean, we've talked about for years, it's all about funding good people who are doing great projects, and it starts with the people first. This business is all about, people. It's about our borrowers. It's about surrounding ourselves with people that we like and trust and believe are kind of in it for the right reasons. So, if that sounds like you, and you may not have done a hard money loan, or you've been borrowing from somewhere else, then reach out to us. I mean, you can always reach out to Chaz, who's younger and has a lot more energy than me. So you can hit up Chaz at congressionalcap.com, or DM him on Instagram. I think that's what they call it. I'm a dinosaur,
Yep.
so I don't even know. But yeah, we look forward to meeting you, and hope you have a nice holiday season if we don't talk to you before then. Thanks for being on with us today.
Yep. Thanks. See ya.